This meeting is being recorded.
Good morning, Sir Michael and friends. Today, Group 5 is going to talk about features of shares and debentures. Next. Here are the topics we'll talk about today. First, we'll talk about shares, ordinary shares, then preference shares, nominal and market value, redeemable shares, debentures, and shares or debentures. Next. Shares. What are shares? According to Investopedia, shares represent equity ownership in a corporation or financial asset, owned by investors who exchange capital in return for these units. There are two main types of shares, ordinary shares and preference shares. Ordinary shares are the most common type of shares and are standard shares with no special rights or restrictions. They have the potential to give the highest financial gains, but also have the highest risk. Ordinary shareholders are entitled to voting rights. However, they are the last to be paid if the company is wound up, with the risk that no money will be left for them to receive. This is why ordinary shares are often referred to as a risk or venture capital. The disadvantage of ordinary shares is that the shareholders can lose their investment if the company fails, and the company has no obligation to pay any dividend. The advantage to holding ordinary shares, however, is the rights to all profits remaining after the preference shares dividend has been paid, and the potential capital growth from profits retained in the business. Owning shares will give owners voting rights at the company's general meeting to appoint directors. The directors will also present the reports and audited accounts to the shareholders, and the dividend to shareholders must be approved. These dividends can be voted by the shareholders to be reduced but not increased.
The other type of shares is preference shares. What is preference share? Preference shares is the share capital that returns a fixed dividend to the shareholders, which is only paid when the company has made sufficient profit. The dividend will be limited to a fixed percentage of the face value and is stated on the share certificate. Preference shares don't carry voting rights in the general meeting, but they have advantages over ordinary shareholders when it comes to receiving dividends. There are two types of preference shares, which are cumulative and non-cumulative. If the shareholders hold cumulative preference shares, the missed dividend paid in the previous years will be carried over to the future years. On the other hand, non-cumulative shares describe the shareholders never receiving the missed dividend. Most companies issue preference shares with cumulative features. As the cumulative feature reduces the dividend risk to shareholders, the company may ask for a higher price for preferred shares. The disadvantages that the company might experience is that preference shares could be a high cost source of finance compared to debt. For example, the dividend rate has a higher rate than interest on loan. Another point is it may increase the gearing ratio, which measures the proportion of a company's borrowed funds with the equity. A higher gearing ratio indicates a company has a larger amount of debt versus equity. In a business downturn, company could find borrowing difficulties or risk bankruptcy. Next. When discussing investments, nominal and market values are significant key terms. Nominal value is not the same as the market value. Nominal value or par value of shares refers to the share value decided by the company at the time of issuance of that share. Book value is the value expected to be received by investors and creditors if the company is liquidated. Meanwhile, market value does not depend on the nominal value, but on the price people are willing to pay for the shares. Public limited companies traditionally sold shares to the public on the stock exchange. For example, in Indonesia, we have what we call as Bursa Efek Indonesia. We can obtain the market value from the closing prices each day or the last price to appear on a stock before the market closes. The stock prices can fluctuate every day. If the company's current or projected performance in the future is great, or more people want to buy a stock, the price increases. However, if the company faces difficulties, such as an unfortunate pandemic, the market price will fall. The shareholders may become unsatisfied and enraged when the stock price declines. They might change some settings, such as vote out the board of directors. It is therefore in the directors' best interest to maintain shareholder confidence. Next. On the PPT, we can see a large screen placed inside the Bursa Efek Indonesia's building. The red color shown in the sectoral box indicates that the index number is experiencing a decline, while the green color indicates that the index number in the relevant sector is experiencing an increase. Looking at the example below it, the price shown was from the yesterday closing price, and it would also show how much the price increased or decreased. Next. Not to mention, Indonesia has also been dealing with severe problem goreng saham. Saham goreng or fried stock is a term for the stock that is managed by several people so that the price soars. They deliberately buy shares of a company in large quantities to increase its price. If there are many other investors who are interested in the stock, they will then sell immediately. This is what happened to PT Asuransi Jiwasraya as the victim in the case of the breakdown of funds of 13.7 trillion rupiah.
Next, what is redeemable shares? Redeemable shares is shares that can be repurchased by the issuing company. Redeemable shares can only happen if the issuing company has an agreement with the shareholders that allows an exchange of shares for cash at a predetermined point in the future. Note, in 2009, Securities and Exchange Commissions and Financial Accounting Standards Board updated the rules for redeemable shares. Circumstances for redeemable shares. First, the company has made an agreement with the shareholders for the exchange of shares. Second, the shares is a restricted shares of the company, or the company is closely held company that has small amount of shares, meaning that the company is a family-owned shares. It's a family-owned company that have their own shares. There are advantages and disadvantages for redeemable shares. The first are large amount of cash and reduce the total dividends to be paid to the shareholders, improve on ratios, rise of the company shares in the shares market, and flexibility to choose for shares repurchase or shares redemption. And there's the disadvantages of redeemable shares, which is the first, a fall in the company cash resulting in reduction of the company liquidity. Second, worsen the current and asset ratios that might affect the company ability of credit purchases. Third, worsen the gearing ratio since it will cause that to be larger proportion of capital employed. For example, the companies may issue mandatory redeemable shares to its employees as a sort of compensation kicker. The company issues such as shares to its employees with a call option. If an employee holding the shares decided to leave the firm, the employer exercises the call option and buybacks the share from the leaving company or employee. The employee is obligated to sell their shares in exchange of cash. Next are the debentures. What is debentures? Debentures is a type of long-term debts that company can take in order to gain more capital and avoid issuing new shares. Since issuing new shares will cause more shareholders, which will affect the voting rights. Debentures are also another type of a common long-term loan that company takes aside from bank loans. If a company fails to pay the debentures, the asset will be owned by the debenture holders, which is the party that gave the loan to the company. Debenture is not part of the company shares capital and does not form part of the shareholder funds. Debenture increase the capital gearing of the company, and company avoid issuing shares because, as I said before, issuing more shares will cause more voting rights for the shareholders. There are different types between debentures and bank loans. Debentures interest are charged and paid based on the company profits for the year, while bank loans usually have their own interest and fixed date. There are types of debentures based on their charge. The first ones are fixed charge debentures, meaning that certain company assets are used as the collateral for the debentures to be paid if the company failed to pay the interest to the debenture holders. And the second are the floating charge debentures. These debentures means that the debenture holders did not specify which company assets as a collateral. In this case, if the company failed to pay the interest, the debenture holders are allowed to control the company assets in certain events, such as when they need to sell the company's property to increase their capital. And there are types of debentures based on bonds. First are convertible bonds. These debentures means that bonds can be converted into equity shares of the company after a predetermined period of time. To investors, convertible bonds are more attractive because the bonds can be converted and the companies they have the advantage that they normally have lower interest rates and non-convertible corporate bonds. And non-convertible debentures means that based on these debentures, the bonds can't be converted into equity shares of the company. They usually have higher interest rates than convertible debentures, meaning that usually companies avoid to take the non-convertible bonds. Debentures also have its advantages. First, the advantages are fixed rate debentures may have interest rate risk. The disadvantages are fixed rate debentures may have interest rate risk exposure in an environment where the market interest rate is rising. Creditworthiness is important when considering the chance of default risk from the underlying insurer's financial viability. And the third, the venture may have involuntary risk in the coupon paid does not keep with the rate of inflation. And for the advantages are, first, the ventures based on regular interest rate or coupon rate return to investors. Convertible debentures can be converted to equity shares after a specified period, making them more appealing to investors, meaning that there will be more investors to invest on the company and increasing the capital. Third, in the event of corporation bankruptcy, the debenture is paid before the common stock shareholders.
Shares and debentures. As both shares and debentures have their own advantage and disadvantage, the main key difference between shares and debentures is the shares represent ownership of the shareholders in the company, and the shareholders have voting rights. On the other hand, debentures represent indebtedness of the company. However, debentures get priority in payment. But there are two different points of view, which is the investors and the company's point of view. By the investor point of view, there are advantages and disadvantages from both shares and debentures. Dividends for preference shares are fixed. Even when the company's profit increases, dividends will be remain. However, when the company is going to liquidation, the preference shareholders will be repaid if there is a sufficient money. Dividends for ordinary shares are paid from profit. If the profit is increased, then the dividends will increase too. This could be an advantage and disadvantage to the investors. The investors may also enjoy the capital growth as all the reserve belongs to the ordinary shareholders. Another note is that the company must have sufficient liquidity to pay out the dividends. The debentures. The investor know that the debenture is more secure than the shares. However, if the interest rates in the company increase, the rewards are less attractive. Another disadvantage is the repayment is worth less. It happens when the debenture is repaid, it will worth less than the original investment owing to inflation. A primary consideration for choosing between preferred shares and debentures depends on its risk. Preferred shareholders are typically promised dividends payments and some liquidation rights. However, shares still trade openly on an exchange with the value primarily dictated by the market. A debenture can be less risky than the preference shares, but will also typically have a lower expected return. Debentures are also higher on the seniority ranking for reimbursement if a company must liquidate. With a debenture, the owner is promised full repayment of the principal investment plus interest over a specific period. Debentures are created for low-risk investors. From the investor's point of view, they are likely to choose shares rather than debentures as they are more advantage than disadvantage, such as higher expected returns. However, it all depends on the investor decision. From the company's point of view, there are advantage and disadvantage. From the shares, dividends are paid when there's profit. There is no requirement to repay shares. It could be upgraded to premium shares, and popular shares could be sold easily. However, the disadvantages are cost of making share issues is high. Dividends will be reduced when the profit remain the same, and voting rights can be affected. The debentures advantage can be redeemed in the future. There are no voting rights. It will not affect the dividends when they are increasing profit, and the directors receive reassurance and financial protection. While the disadvantage are no flexibility in making the payments to the debenture holder. If the debenture is secured, the business may not have the freedom to sell certain assets. They are repaid in priority. Through the company's point of view, it is likely that debentures are a better choice as there are no promising dividends when the profit is increasing. There will also be no share rights given. To conclude, both shares and debentures have their own advantage and disadvantages. It all depends on the company's and investor decision. That's all for our presentation. Thank you for listening.